Hi, this is Keith Schneider, and this is April 10th edition of Market Outlook. So a bit of a corrective week. Let's get into the charts right away. Don't forget to sign up for this free video newsletter and also the text version by going to www.marketgauge.com. All right, so as you can see here, lots of sideways action over the last couple of weeks. More importantly, we established some pretty interesting chart levels. First of all, take a look at the weekly chart here. And you can see with the weekly chart, we're definitely having this downward sloping trend line. Let's put that in. And you can see that we're pretty much topping out, potentially topping out a little bit before a potential breakout of this trend line here. But more importantly, we paused right at the key weekly moving average. We tested it on Friday on the sell-off, but managed to close above it. That critical number now on a weekly basis is a close just under or around 203. On the daily chart, slightly different picture, although you can see we've got the 200-day moving average coming in around 201.50. So if you want to clear both the weekly and the daily moving averages, you're really talking about a move just under 200 would, for me, put this into clear corrective mode. And again, you can see volume here definitely trailing off, right? Ever since the big decline, obviously when institutions want out, they're not using dark pools. They're going right to the market. When they're buying, they're being a little bit more selective. And again, as you can see, the average daily volume definitely trading on average under the 50-day moving average of volume on this rally. So not a ton of conviction. So that pretty much gives you an idea of the overall condition of the S&P 500, which to me is still your benchmark index. So still holding above important levels, but clearly momentum slowing down. And I have here a really interesting chart that measures the momentum. So the baseline is the this is the moving average on a weekly basis. This goes back 65 weeks. So this is a 65-week moving average. And the blue line is a moving average of the momentum of just how far the S&P is closing above or beneath the actual moving average. And as you can see, as the market was making new highs, right, we were pretty much following in 2013, and the momentum was increasing. Since mid part of 2014, you almost have a perfect type of curve here where the market is topping out and the momentum is rolling over. And essentially, when this blue line covers this black line, that is that 65-week moving average, the black line itself. And as you can see, it has actually acted as pretty interesting support. But more interesting is the fact that even though we moved above that key moving average on a momentum basis, all we did is touch the top of the actual measure of momentum itself. So in essence, we pretty much topped out last week and then closed just under it. And also pretty much right at the moving average. So it's interesting. This downward sloping curve here is showing the rounding up here on top of the actual price action of the S&P. So up here is the price action of the S&P. This is your 65-week moving average, a little bit longer than a year. It's a number that I like to use. And again, this is the actual measure of momentum, which is just how far the market is actually closing above that 65-week moving average. So there you have it. We're sort of topped out, and that's what I mentioned in the text version. We topped out here. So that's pretty interesting. Now, a couple things to note. Let's take a look at a couple of other charts here. Let's take a look at GDX. So obviously, moving into gold miners, look what's happened. We had a slight pause for a good part of March, and we closed on new highs. So money moving into gold miners. That's pretty interesting. And we have what I would call a pennant formation. And on Thursday and Friday, we broke out, closed at new highs for the year. This thing is definitely looking like it's in gear. Of course, a break of the wedge formation, which is around the 19 level, would negate the pattern, but right now it's in gear. We'd like to see a bit more volume kick in on the absolute breakout to new highs, but this is interesting, and certainly as the market seems to be stalling, the gold and gold miners and other commodity-based trades are doing rather well. So for instance, let's look at GLD. And again, similar type of pattern, although not quite as strong, but interesting. You can see that you have a nice channel line here. We broke out of it on Friday. You sort of got contained pretty close to an inside day. It'll be interesting to see what happens. Again, under 116 would negate the pattern. We'd break the 50-day moving average on the daily chart in gold. On the other hand, a move back out to the upside would clearly help. Taking a look at a couple commodity-based economies, taking a look at Brazil, you can see Brazil has had a really nice move off the lows, holding that 200-day moving average. And on Friday, it was up a nice 2%. So there are some political things going on there as well, but overall, this seems to be holding quite well. So that's this is Canada, EWC. What we want to do is take a look at EWZ, Brazil, and you can see Brazil, also another commodity-based economy, and that was up over 6% on Friday. And also potentially with the cloud clearing in Brazil from a political standpoint, and of course it's commodity-based, would be a big help here. So this looks like a potential cup and handle with a nice formed handle. If we can get above that 27 or 20, let's take a look here, close above the 2750 level, you definitely be further in gear. So to me, this relative strength relative to the S&P 500 is showing that commodity-based plays are definitely taking the fore here. So that's where we're focused on for now. Let's take a look at some of the market internals. We're going to go to Little Big View, which is on the Market Gauge website. And again, you can keep track of that every day and see how the indicators are doing. So first of all, looking at the market internals on the S&P, up-down volume. You can see we went down below the zero line. We got overbought, and finally we got some confirmation down here. We were a little bit concerned about what might happen here, and we got our answer. So the market clearly is under pressure. I look at that as more of a negative. The McClellan oscillator, which looks at advanced declines, really over about a 3-week to 4-week basis, clearly under pressure. We got overbought, and when it broke the zero line up here, that was your sell signal. that worked pretty much like clockwork, pretty interesting. That worked quite well. And again, that is negative. In terms of looking at the advanced declines, holding up a little bit better. But net, looking at the S&P and the internals, we have, I would say, a net slight to moderate negative. Let's take a look at a similar chart, but looking at the Nasdaq. And this is the broad index, the composite. So this is all the Nasdaq stocks. And so here you have it. As you can see, Nasdaq never got quite underway as the S&P 500 on the rally. In fact, we essentially got overbought here, and finally the sell signal, we got a couple of days under the zero line here, which indicates a potential sell. Now, what we want to do is look at the internals and then have it confirmed by price. And as you can see, the 50, the 10, all these moving averages, excuse me, this is the 200-day, this is the 50-day. So the 10-day and the 50, we're basically hanging on right here. So a move either way above this consolidation to the upside would certainly flip these indicators positive. But right now, what we're seeing is the indicators are certainly pointing to a potential test of that 200-day moving average and a move to the downside. But of course, the price action has to confirm. So in this type of market, trying to figure out anything more than things on a technical basis is virtually, I think, very, very difficult. Looking at the macro or the fundamental picture with negative rates and some of the unintended consequences make it extremely difficult to figure out what's going on, and you must trade on price action. So there you have it, right? A breakdown beneath those moving averages and the last 3-4 days of action in the composite is definitely going to be your tell. Okay, let's take a look at some of the other charts here as well. Taking a look at the S&P 500 on the new high, new low ratio, that is well intact. Obviously, we want to see this fail, this upper line here, but things are actually improving. So if you're looking at the overall picture, the advanced declines, up-down volume, definitely slightly negative to mixed. However, another measure, the new high, new ratio, the new high, new low ratio is doing quite well and holding up. So that is certainly a positive. Let's take a look at Nasdaq on new highs, new lows as well. And in this case, we use the Nasdaq 100. And in this case, we're holding up extremely well, even though the advanced declines and the up-down volume are showing some weakness. So a bit of a mixed result looking at this particular indicator as compared to the breadth and the volume indicators. So balanced picture. The balance definitely tips this into making sure that you're looking at the pure price action as your confirming indicator to actually enter a trade or to give you a bias here. Let's take a look at volatility. As you can see here, volatility, we're sort of, hanging out at the lower end. Have we hit a bottom here in terms of the Bollinger Band, which would show, excessive optimism? Absolutely not. The bands are definitely compressing, which means that the market is definitely moving into a compression zone with that sideways action. That's not surprising. So we definitely want to see how the market's going to behave around this moving average line here, which is around the 19 level. So we start approaching the 19 level. That would also be another confirming indicator that the sell-off is materializing and possibly a lot more persistent than we would hope for. All right, let's take a look at a couple of other indicators, or at least I think there's one last indicator here. This is actually one of my favorite sentiment indicators, and this one in particular looks at short-term volatility versus longer term, so it's 1 month versus 3 month. And you can see we got pretty overbought up here. We couldn't actually close under the secondary line here, but sort of held up and the market went sideways. So one of the things we want to see here is a continued move down. Right now, this is looking like sentiment after its massive move off of the mid-February lows, and now we're moving. We got well above what I would consider some frothiness, almost reached extreme frothiness, but now has faded and has gone sideways and has broken an important support level. And if we can't get through and back over that blue line here, this blue line here, which is I believe 1.2, you're gonna see further erosion. So from a sentiment standpoint, I'm looking at this as more of a negative and potentially a fresh sell signal. So net, slightly biased to the downside on some of these indicators. Some of them are positive, like new highs, new lows, neutral to negative on the advanced declines, and sentiment clearly looks like it's rolling over. And with the market stall on the momentum, I'm looking to be a lot more cautious right here at these levels. All right, well, again, stay frothy. These markets are super directional. They're either straight up or straight down. And so it's really important to pay attention to these levels where we are right here and to be flexible. Let the market action tell you which way it's going to go. But you do have some nice sideways action. Let's see how the market plays out. I would be a follower and between those levels that I pointed out on the downside, and on the flip side, if we can get above the recent highs, it just might be that markets continue its upper move here. So you've got this market bracketed in a nice way. Thanks. Have a great week and see you next weekend.